Are you looking for a way to reduce your taxes? It's kind of a rhetorical question. Who isn't, obviously? Well, here's a new one for you. The short-term rental loophole can help you deploy your current home, second home, whatever, to reduce your taxes. But how does it work? What are the requirements? Well, my guest today runs an accounting firm that helps their medical clients get efficient on taxes, including using the short-term rental loophole when it applies, and she's going to explain it all to us. I'm Carl White, principal at Mark Advisory Group, which is a healthcare marketing agency, and I'm also the host of Practice Care. The mission for both is the same, and that's to help private practice owners stay private. It's usually what they want anyway, but I believe that care is better when the providers of care own the practice, because all the clinical decisions, all the business decisions, they're made by the same person or group of people. Sometimes they ripple off each other, and I think it's better when it's the care providers who are making those decisions, because that way the patient always comes first. My guest today, my returning guest today, is Alexis Gallati. Alexis is the founder and lead tax strategist at Cerebral Tax Advisors and Cerebral Wealth Academy, and she's the author of the book Advanced Tax Planning for Medical Professionals. She has over 20 years of experience in high-level strategic tax planning and multi-state tax preparation, and she's trained at the highest level, holding 2 master's degrees. Alexis grew up in a family of physicians and is married to a private practice physician. That's why she understands how hard medical professionals work to get to where they are, and why she provides simple and accessible tax solutions tailored to busy physicians. Alexis, welcome back to Practice Care.
Thank you so much, Carl.
Yeah, it's good to have you back. These are, I love researching these topics. I don't know. It's funny. I get geeky about these things until I start reading about them. Then I go, it's better I talk to Alexis, because this is getting really confusing really fast. God love our tax code.
That's fair.
Yeah, so we're going to get into this. But first, tell us a bit more about you, about Cerebral, the academy, as well as the advisory firm.
Yeah, definitely. So I started Cerebral back in 2014 after, not really, when I saw that my husband was going to be finishing up residency about a year and a half later.
Mm-hmm.
And yeah, I saw the writing on the wall. I knew that we were going to be hit with a much bigger tax bracket, and I wanted to know why the Warren Buffetts and the Bill Gates of the world were at those lower tax brackets. And so I started Cerebral to really dig into that proactive tax planning, and it really blossomed into just like you. I love researching and figuring out, hey, how can I save more? Just because, and we're in the same exact situation, my husband Chris and I. And when it comes to these strategies, I've found, obviously you guys don't have any education whatsoever, like in medical school and residency, when it comes to running a business or the tax code. So that was my mission, to just kind of help dumb things down. You guys have a gift for medicine. When it comes to science, it just goes straight over my head, despite my husband's best efforts.
Yes. Yeah, that's true.
But when it comes to tax code, that's where I really shine. And where Cerebral Wealth Academy came into play, allowing me to really help educate, physicians, just so that they just get the information and try to help eliminate surprises for themselves. And, one of those strategies being the short-term rental loophole has, really helped a ton of physicians and just, investors in general. I feel like it's really taken off. Really, I would say since COVID. I feel like there's been so much more activity. I don't know if it's just because people realize that the economy can sometimes be so fragile, and wanting to have something else to create some passive income and not just rely on your salary.
Yeah, I wonder with COVID, like we don't know, but everybody was home. And so like in 2020 and 2021, if you were a tradesperson, like a general contractor, at least up where I am in Chicagoland, you were killing it. And the theory was, well, people, instead of going away or spending time out of their house, they were in their house for way longer, and they started to notice, oh, we want to fix this or that or whatever. And so I wonder if, and listener, you'll understand what I'm saying after we talk about this short-term rental loophole. But it involves your house, or at least it could be your primary or a second house, or whatever, as long as you own it. I don't know. I kind of wonder. We should have a separate episode also about why Warren Buffett pays a lower tax rate than his secretary, which he is on record as saying, number one, that happens, and number two, how terrible it is over and over again. But he doesn't seem to restructure his wealth to pay more, but as he could, if he thinks it's so bad. But we should have a separate episode on that. So let's get into this. The short-term rental loophole just rolls off the tongue. This is a passive income. So let's start with the basics. What is this? What are the rules? Like the basic rules. I'm sure there's like 30 pages on the rules, but just kind of get us started on this.
Yeah, definitely. Yep. So the short-term rental loophole, which I'm not quite sure why they've called it a loophole, because it's not a loophole. Loophole always sounds so like scummy
illegal
and dirty.
Yeah,
Exactly. But
you shouldn't do this. Yeah,
but it's not. So, but I guess nobody's come up with a catchier name.
See, like the Augusta rule. So the Augusta rule is a cousin of this. We're not talking about that thing. That's a great name. It's section 230B, whatever, but let's just call it the Augusta rule. It's just a much better. Anyway, keep going.
Nobody wants to hear code sections. So
no, the Augusta rule. So the short-term rental loophole, it's also very difficult to say. So it's not a great name, but keep going.
Yeah, sure. Yeah. So the premise around this is that if you have a qualifying short-term rental, then you're able to convert any losses that occur from that rental from being passive to active. And when that happens, those losses can actually be used against your ordinary income. So think W-2 or from your business, like your S Corp, et cetera. And then those losses can be used to help lower your taxable liability.
Okay.
Yeah. So that's kind of a very high level.
Yeah.
So I think it would be great for us to go into,
Please.
What are passive losses?
Yes. And then we'll get to how they apply here. Yeah.
Yeah, definitely. So when you run a business and you have a loss to your business, that's considered an active loss. And that's just because you what's called materially participated in that business. So you're working in the day-to-day.
So you own a practice and you have a loss that's active because you are a doctor running the practice. It's very active.
Exactly.
Got it. Okay.
Yep. So you can use those losses to offset your other income. Now, the IRS says that real estate, by default, is considered a passive activity. And so that means that you're not allowed to put any passive losses against your any passive losses against your active income.
So passive has to stay with passive, active has to stay with active.
Exactly. So if you have, let's say you have two rental properties and one rental property is, in the positive, but the other one's in the negative. Well, the negative can of property B can offset the positive passive income of property A.
Got it.
Now, where that starts to get a little sticky is that people want to be able to use those passive losses in the current year. Well, what happens if you don't have any passive income to put against it? Then you have to carry forward those passive losses indefinitely until you either have passive income to put against it or you sell that property. So those losses are suspended and carried forward until you have one of those two activities. So if you have $100,000 of passive losses that have generated, let's say over 5 years, then you sell the property, those losses are released, and then you can use those losses against any gains you may have or against your active income from like your W-2.
Got it.
Yeah.
So passive income, so passive losses have to stay matched against only passive income or the sale of the passive asset.
Yep. Exactly.
Got it. Okay.
So there are a few exceptions that you can do in order to make those passive losses active losses, so you can use it against your active income. One of them is the real estate professional status, which you would use if you had long-term properties. And that's like a whole episode on its own, basically.
Forget that one. Okay. Yeah.
But, and then the other is this short-term rental loophole. And so this is, again, when you have that short-term rental and you meet the qualifications, which we'll talk about in a moment,
Mhm.
then those losses can now be considered active because you're materially participating in the eyes of the IRS, and those losses can now be used against the your active income. So what we're trying to do is just change the character of those losses from being passive to active. So you're getting a current year benefit
Mhm.
as opposed to having to wait for that benefit in future years.
And so I guess now I get why the term loophole is used, even though it's not really, it's legal. And the loophole is you can take something that is passive and make it active.
Yeah.
Okay. All right. So, the next question is the benefits of using it. Maybe we just answered it. It's because you can take losses that would otherwise. And now I'm curious, what if there's income? Like, I guess if there's income, it doesn't matter, right? You've got the income, you're happy.
Exactly. Yeah. Oh, believe
Okay.
me, if you have income, the IRS wants you to pay tax on it.
Fair
So
enough. Whether active, passive, blue, gray, whatever. Yes. Okay.
exactly. So then that's where if you do have passive income, then you might want to consider some other strategies like a cost segregation study or purchasing another rental property that will
Yeah.
generate some passive losses, or other investments like oil and gas that will throw off passive losses, especially in those first years.
Yeah.
A real estate syndication. So essentially, you want to look for other passive loss generators that
Yeah.
will help to offset that passive income.
Right. Right. There's no problem with paying taxes, right? If you're earning money, you should pay some taxes. And so that's a good thing. But here we're talking about in this episode, ways to reduce taxes. Okay. So how do you get this? What does it take to qualify?
Yeah, yeah. So what you need to do are basically three different main eligibility requirements. One is the property needs to, on average, be over the average rental period needs to be over 7 days. So
Okay.
when you go to rent out to somebody,
Mhm.
then, if you're having people regularly renting out for a month,
Mhm.
that's not gonna qualify you for that 7-day rule, unless the average can be 30 days, as long as you're providing some sort of substantial service. And so that means something like you're an Airbnb or you're giving tours. So you're providing something else within that rental
Mhm.
besides just saying like, hey, you can use my place.
Okay.
Yeah. And then the second requirement is that you are the one spending the most time on that property. So if you have a short-term rental and you're using a property manager, then you're most likely not going to qualify because that property manager is probably spending more time than you on that property.
Mhm.
But what's nice about this is, like, unlike the real estate professional status where you need to spend more than 50% of your working time
Mhm.
on your real estate activities, this is a much lower hurdle for physicians, because obviously if you're like a full-time physician, then you can't be spending more than 50% of your time
Mhm.
doing real estate activities. So all you have
Mhm.
to do is just spend the most time on that property. So you really should be the one approving the tenants, scheduling that plumber, doing some maintenance,
Okay.
etc. And you do have to keep records of your time and your involvement, because one of the other requirements is that you spend at least 100 hours a year on that property, which really isn't
Okay. It's not that
very
much.
long. Yeah,
Yeah.
if it's 100 divided by 52
It's two
weeks
and a
of the
half
year, it's
weeks.
about just under 2 hours a week.
Yeah. Okay. So it sounds like you're describing some ways where it's almost like the requirements are it's passive because it's not a lot of time that the person is renting out the home or the room or the whatever. But there's a little bit of activeness too, because you're the one doing stuff when needed
Exactly.
rather than anybody else. So you're sort of
Mhm.
having a bit of both. It's passive because it's short term, but when somebody's there, it's active enough because I, the owner, am the one fixing things, providing a service, whatever it is. Is that kind of the way to break it down?
Exactly. Yes.
Okay.
Now you can have a property manager. It's just you would need to document that you are spending more time than that property manager. So you might have to ask them for the hours that they spend
Hmm.
on your property,
Hmm.
and just make sure that you have enough. But just like anything with the IRS, 90% of a fight is documentation. So it's really important that you're keeping track of all those hours. And investor activities like going and researching on Zillow, for example, like, hey, what's going to be my next property? Or, um, dealing with bank loans, et cetera. Like that's considered investor activity and not
Mm.
active
Like,
daily management activity.
got it. Okay. Are there are there any areas where you see clients kind of commonly trip up? Because it's like you got to be active, you got to be active, but you got to be passive. And it's just I could see me doing something thinking, oh, that's active, or that's the right one, active versus passive, but getting it wrong in some way. Are there any like sort of, beginner mistakes?
Just like I mentioned, not going and documenting things properly.
Okay.
And
Okay.
also to not keeping track of all of your expenses properly. You got to
Mm.
treat it just like a business.
Hmm.
You depending upon your state and insurance rules, et cetera, you'll want to have that business in an LLC
Hmm.
just to separate that liability. Because if someone were to fall down, you
Oh
don't want them
yeah.
to come over after your other assets.
Hmm.
Um, and keeping separate bank account, separate credit card for you have
Hmm.
to run it just like a business. And so that's really important in the eyes of the IRS that you treat it as such.
Okay. Which would make sense. I mean, for another reason, because where I was, that helps me because I'm thinking, all right, I'll make up a scenario. We have a second home, and the second home, it wouldn't even occur to me to say, well, where are these losses going to come from? I mean, it's a second home. We bought it because we want to take vacations from time to time, and that's where we go and build family memories, etc. Where would these losses be? It's coming out of Carl White and my wife and the individual. But now this is different. We're saying now it's going to be, second home LLC or whatever. Don't get hung up on the corporate structure or whatever. It's now second home LLC, and now every expense associated with this second home is it's an expense, which means if the expenses are greater than the income, there's your loss. So now we rent it out for the right amount of time to the right people, but that's still, let's say the expenses are 50 grand a year, and we just made 15,000 in rental income using the short-term rental loophole. So the $35,000 is a loss, which I can now, you're saying, assuming I did it properly, that $35,000 I can use against the rest of our income to reduce our taxes. Is that right?
Correct. Yes.
Okay. So then if I wanted to take, before we started recording, I said, I'll make it up. I've got two kids in college, which means 9 months of the year, I have two empty bedrooms. And I thought, hey, you know what? Let's try this. Let's rent it out. Um, would I have to take those two rooms and kind of carve them out somehow to say that's now, you know, to be named LLC? And that's just sort of, I would have to do that, right?
Um, I when it comes to just a room, I don't. You probably want to talk to a real estate attorney about whether or not it needs to be in a separate
Okay.
LLC or not.
Okay.
I mean, you would definitely have to talk to your insurance company, being like, hey, make sure I have enough
Yeah. Yeah.
renters
Yeah.
or
Yeah.
renting insurance, et cetera.
Hmm. Hmm.
Um, but in theory, yes, you would, be able to write off, let's say it's the room that you're renting out is 10% of your home,
Hmm.
then you could write off 10% of the expenses associated with your home,
Right.
including depreciation.
Okay. Okay. Interesting. Interesting. I don't know if you know the answer to this, so I'll put you on the spot. How did this loophole come into being? Like, how did this get, like we were talking about before we started recording, the Augusta rule? We know the history of the Augusta rule. Separate episode, listeners, but we've got episodes on that. How did this even happen? Do you know?
I
Like, if you don't know, it's fine,
no.
but
Yeah, I'm not sure of the origin of this one. It's probably not as interesting as the Augusta rule, but it's probably why.
yes, people fighting the good fight in Augusta, Georgia. Okay. Um, is there anything we should have covered that we kind of had some basic questions here, but this is like a just sort of wrap your head listener. I think that the big takeaway is if you think this applies to you, get with your accountant as step one, because you can do this, but if you're not careful, it's gonna, come back to bite you. But is there anything you think that we need to hear that we just didn't get to about this?
Yes. So when it comes to the deductions and such that you can be taking,
Hmm.
you'll want, obviously we kind of discussed, like you can do utilities and you can do any of the maintenance, et cetera, that you have, but also think about your expenses. Like if you have to travel to there
Mm.
and you need to, because you need to go look at something, you just want to check up on the place.
Hmm.
So I have some clients that will have, like I have a client that has a beach house in Hilton Head.
Okay.
And so they'll go there and they spend part of their vacation, doing updates, et cetera, on the rental. And so
Hmm.
then that allows them to use the property. You have to be careful not to use it too much, otherwise it can be considered a personal property.
Hmm.
But and then also too, they use the cost segregation study tax strategy to really bolster their depreciation deduction in the
Hmm.
first year.
Okay.
And for those that might not know what the cost segregation study
Yeah,
is,
please.
essentially, let's say you bought a house for $100,000 and you would normally depreciate that house over 27 and a half years.
Hmm.
But with the cost segregation study, it would take that 100,000 and the home and break it up into different components. So assets within the house that are 15 years or less. So
Hmm.
like lighting and fixtures, that they're considered a 5-year property. And so, or 5-year asset.
Okay.
So those are then broken up. So like, let's say that 20,000 of the 100,000 is in 5-year property,
Hmm.
then you can go and depreciate that 20,000 over 5 years instead of the 27 and a half years.
Hmm.
So you get that bigger deduction
Hmm.
up front.
Hmm.
Um, and so this is very beneficial because then you can have that loss and then you can use that loss against your personal, ordinary income.
Right.
Um, and I have some clients where they're purchasing a new short-term rental every 1 to 2 years because they are taking advantage of that cost segregation study. And this is all part of their own retirement plan.
Got it.
But one other thing that I think is important to realize if you're going to be going down this route is that short-term rentals right now, like it's a very saturated market.
Mm.
So you really want to make sure that when you're looking to do this strategy, you're not just taking the tax benefits into account. You're looking at the appreciation value of the investment.
Yeah.
You're also looking at the cash flow value, making
Hmm.
sure like, hey, like the whole point is to have people rent out your home and cover all the expenses, the second
Yes.
home. So then you have that appreciating asset. It would be great, yes, if you can get some extra money from it on a
Hmm.
monthly basis.
Hmm.
But at a minimum, you want your taxes and your insurance and
Yeah.
mortgage, et cetera, covered.
Yeah.
So then that way, essentially, it's an asset that's only just growing in value and not costing you anything.
Right. Yeah. The
So,
point of all this is to not to take advantage of a tax loophole, because for every dollar you make, you're not going to save a dollar in taxes, right? It doesn't work. You save a
exactly.
percentage of it. The tax rate is not 100%. It's less than that. So yes, still make sure it's a good money move. But along the way, if you do things right and it makes sense for you, you can wrap some tax savings along the way.
Exactly.
Okay, great. Anything else you think we should have hit of at this point in sort of the very introductory level discussion about this opportunity?
No, I believe that gives
Okay.
everybody a good foundation to start kind of doing their research and seeing if this is
Hmm.
a good strategy for them.
Great. Perfect. Well, Alexis, thank you for coming on, for coming back. You bring all sorts of cool, unknown to the layperson like all of us, um, some knowledge about taxes and some knowledge about accounting and some knowledge about how to save money on taxes. So I really appreciate you taking the time once again and helping us out with this one.
Thank you so much, Carl. I always enjoy our talks.
Yeah, me too. And as I've said for your other episodes, we've got your contact info, which we're going to put into the show notes for this episode. So anybody who wants to contact you, they now have yet another way to do so. Two quick points before we wrap up. First, if you haven't subscribed to Practice Care yet, please do so. Practice Care is one word. We're easy to find. We're everywhere. And it's the easiest way to stay up to date with new episodes, which we drop every week. And also, if you're like Alexis or us, you serve private practice owners, or if you're a private practice owner yourself and you've got some experience or expertise on the business side of private practice, please come on Practice Care and share your knowledge with the world in Alexis's show notes for all of her episodes. And every episode, there's a link, a couple of clicks. It's quick and easy. Just tell us what's on your mind and we'll get you scheduled as soon as we can. Thanks very much. And until next time.